Hello, everybody. It's Tuesday, May 26th, 11 a.m. here in Long Island. And I'm very happy to say that Max is here. I don't think he's paying much attention, as you can see. And he's there with his Yardeni Research blanket. The rest of it says Yardeni Research. So, anyways, he finds comfort that everybody's got their little security blanket, so that's his. Mine too, I should say, since Yardeni Research has been a good source of uh, fun professionally, and so on. But let's get to the point. Oh yeah, I forgot the weather. The weather. It's We had a real wet Memorial Day, so that was a wipeout, and didn't do much other than go out to see a movie. Saw the Devil Wears Prada 2. It was okay. It wasn't great. I'll review it when I have a chance. And other than that, it's back to work. And the market is working sort of kind of, it's kind of a mixed story. It looks like the Magnificent Seven are having mostly a good day, and the rest of the market's kind of doing nothing. I get the big question, of course, is do we have a deal or not? Deal or no deal? And the answer to that is nobody seems to know. The president thinks there's going to be a deal, but he keeps saying that we're on the edge of a deal, and then he keeps kind of backing off and say, well, there's really no rush to do a deal, and we want to get a good deal, and a good deal would be good for everybody. And if we don't have a good deal, we've got no deal. So, deal or no deal. We'll see. The markets, obviously, since we made a low on March 30th, have been anticipating that there will be a deal, and that the price of oil will come down. I think we all have to be kind of amazed why the price of oil hasn't gone up a heck of a lot more. I mean, when the war first broke out, all the headlines were this is 20% of global oil was locked in the Persian Gulf because of the war. And then things didn't get any better. The U.S. blockaded Iran's shipping, and Iran basically, in effect, shut the strait. And now they're talking about the strait being theirs. They're going to manage it. They're going to charge a security fee, whatever, and only ships that they approve of can go through. And of course, that's totally unacceptable to the United States and just about every other country around the world. The free navigation is something that everybody takes quite seriously. Though one has to say that the Chinese aren't taking free navigation very seriously in the South China Sea, but that's a whole other story, and we don't have to go there right now. So the war's still going on. The market's doing what the market has often done, and that is viewed geopolitical crisis as buying opportunities, and so that's been the case so far. Price of oil is now this morning slightly below 100, and everybody thinks that if the war were to come to an end tomorrow and the strait were to open, that it would still take quite some time to get everything back to normal. The oil market, people are asking, well, if that happens, how low can the price get? Well, it's not going to go back to 67 to $60, $70. I think everybody would agree with that. Sure feels like as though it could go back to $80, which again would be quite remarkable given the damage that's been done in the Middle East. The fact that oil tanks are basically empty and will need to be refilled. Strategic petroleum reserves will need to be refilled. And of course, everybody's going to want to have even more strategic petroleum reserves under the circumstances. And it's going to take a while also to get new infrastructure pipelines that reduce the global dependency on oil oil getting through the Strait of Hormuz. Of course, we know that there are other explanations for why the price of oil hasn't spiked up. Um, my most likely one is that China's economy is actually pretty weak. We saw that in retail sales. It's pretty clear that the consumer there is not spending. I mean, they're spending, but there's no growth, and that they've been very dependent on exports, and maybe some signs that this war clearly is maybe having some impact on global economic growth, therefore on Chinese exports. So I think a big part of the story is China is not buying as much oil, or they're not increasing the amount of oil they want, and they have apparently some pretty sizable strategic reserves, so they're probably cushioning the shock of what's happened in the Persian Gulf. They're very dependent on Iran, and so that was a big shock. At the same time, I think the White House is not paying that much attention, or kind of gave Putin a wink wink that, for now, under the circumstances, the U.S. is kind of busy dealing with the war and isn't going to be counting Russian oil that gets to China or gets to India. So I think India, which is a very big oil importer, also is getting oil from Russia. And then we haven't put any export controls on oil. I guess we want the world to know that we're a dependable source of oil if they want it. And of course, the problem with that is by not having export controls, our oil price is determined by the world oil price, and the world oil price is basically Brent, though uh, there's other varieties of oil. But all in all, we're selling more. And then I think I'm not quite sure about whether Venezuela is able to scramble to sell more oil, but one way or the other, apparently the shock has been somewhat cushioned. And of course, some oil is getting out from the pipelines that Saudi Arabia has to the Red Sea. So far, the markets have handled this $100 oil price remarkably well, really around the world. I mean, just a hint that negotiations were still on, and we're making some progress. On Sunday night, Monday night, we saw that the Kospi, the Korean market, went to an all-time record high, and the Japanese Nikkei went to an all-time record high. So looks like, and of course, if we do get a deal, then I would think that some of these stock markets abroad would outperform the U.S. for a while. We kind of reiterated our position that go global does still make sense, especially when the war is over. The biggest beneficiaries, the stress will be relieved most clearly in emerging markets that import oil, and also the European economies that import oil, which I guess is just about all of them. So we did not do a morning briefing because of Memorial Day, but we did continue to send out our quick takes. Let's go there and have a look at some of these charts. So here we are. This is our research, Yardeni Research website. We're on the quick takes page. You can always go here to look at charts. You can always go here to search charts. We have AI tools now. You can see Beige Book Monitor, FOMC minutes, and so on. So when some of these uh, texts come out, if you want to, press releases come out, they're pretty long. If you want a quick summary, you'll see it in our AI tools. So let's go. Well, so if you go to research, you could get the morning briefing, the weekly webcast, and here we are on the quick take. So let's go and look at FOMO versus FEMO. FOMO, we all know, is fear of missing out. FEMO just concocted this weekend. Got inspired to say, well, everybody's. I was actually getting some questions of one or two questions of whether this rally is all about FOMO, and I think it's actually more about FEMO, fabulous earnings momentum, which we've discussed before. But we do like to update you on the situation so you can get a gander of whether this is still ongoing. Well, this chart is kind of fun. It shows year to date how much of the S&P 500 increase of about 9%. So that's the red line here. That's the FOMC. That's I'm still thinking FOMC. This is the S&P 500 year to date is up about 9%. And you can see the forward PE is actually down since the beginning of the year. And all of the increase is attributable to this, which is forward earnings. So forward earnings has increased more than the forward PE declined, and this is what we get as a result. So FOMO would be kind of the reverse. We'd see the forward PE really taking off because when you have FOMO, fear of missing out, people just want to get in the market. They're not really thinking much about earnings, whereas FEMO is all about, well, uh, I'm not sure I want to be in the market. On the other hand, the earnings are so strong, maybe I should be in the market. But it's not a PE event, it's an E event, just to distinguish it between the two. So let's focus on FEMO, on earnings. We've been showing you this. We had a little minor slowdown a week before. Current week, I think now we're kind of well past the not well past, but we're past the Q1 earnings season, and you can see that forward earnings all-time record high. You can see that the analysts keep raising their numbers. Let me make this bigger. I can barely see it. Okay, there we go. So right now, remember at the end of last year, we were talking about 310 for this year, and we thought that was a kind of an outlier bullish, and we were thinking 330, well 350 for next year, and here we're the analysts are at 337 and 390. Now, some of that, of course, is being led by the Magnificent Seven, the semiconductor stocks, by technology generally speaking. But as we'll see in a second, it's not all about the Magnificent Seven. Um, this is the forward earnings. We just showed you how we calculate forward earnings. It's the time-weighted average of the current year and the coming year, and see that we're going to converge to wherever this thing ends up at year end. And right now it's kind of up, and away. I mean, I would think at some point it's going to kind of level out here because we keep kind of uh, remaining bullish, but not bullish enough on earnings. I mean, we raised our numbers from 310 to 330, and for this year, and we raised our number from 350 to 375, and right now the analysts are still more bullish than we are. We're not as bullish as the analysts. Um, this is almost hard to believe these kind of numbers. Um, and I guess this gets into the issue of is rational exuberance just a PE phenomenon? Could irrational exuberance be an E phenomenon that the analysts just get all hyped up about AI and how amazing that could be? Um, but some of this hype is actually because earnings have come in a lot stronger. So then that gets you to the question of the reliability, the quality of earnings of some people, and we followed up with an analysis showing that yes, indeed, some of this earnings is mark to market of investments that Magnificent Seven companies, the hyperscalers, made kind of in each other and in some of the other infrastructure AI infrastructure companies, and so isn't that sort of a speculative bubble? And the answer is not yet. And right now it's kind of still the real deal. I mean, Intel's recovery is real. The marking up the value of Anthropic and OpenAI makes sense in my humble opinion. But at any rate, as you can see, the forward earnings a number goes all the way back to 1994, and it's a great coincident, even leading indicator of actual forward earnings, actual earnings quarterly, except they don't get recessions. So you say, well, what good is it? Well, it's really good if you have a strong opinion that there's not going to be a recession, then you can pretty much count on this being realized in the blue, in the actual. And we've been arguing since the beginning of the decade that the economy is resilient and won't have a recession. And the market seems to be buying that idea more and more. And certainly the analysts are buying it with their earnings expectations. So this is FIMO, fabulous earnings momentum, right? We've had a few other instances. We had some back here. This wasn't really a major change in the slope, but this is really quite unusual. Um, this is the profit margin. It's not just revenues. I mean, the revenue story is remarkable because you would think with what's going on in the global economy, the S&P 500 revenues would be showing some signs of a slowing global economy, and that's just not the case. Now, maybe some of that is inflation in the energy sector, so that'll boost revenues. Max is really having a good sleep there. Um, and of course, the profit margin has been going up. This is forward profit margin, which also correlates very well with the actual profit margin for the S&P 500. Joe Abbott, our colleague, put together this nice chart, which allows us weekly to basically look at earnings breadth and revenues breadth. And as you can see, earnings breadth. The blue line keeps going up here. In a bear market, earnings breadth takes a dive. So that could happen pretty quick, but we don't see that kind of scenario anytime soon. And it's really the argument for if earnings breadth is widening, broadening, that should impact the market. Right now, the market's back to being fairly concentrated and focused on a few, the Magnificent Seven. Magnificent Seven earnings look great. This is on a ratio scale, so we're not exaggerating it by having it on a regular arithmetic scale. And this shows the S&P 500 forward earnings, and this shows the 493. And the 493 were kind of in a coma here for a while as the Magnificent Seven were growing, but now we're starting to see that this is moving into record high territory. We put together, David put this together, this chart on S&P 500 sectors long-term earnings growth, and this is analyst consensus expectations for earnings over the next 3 to 5 years at an annual rate for the S&P 500, and they're at 21.9%, and you can see that that's led by a big growth. I can remember this was an annual number. So this is 34.9%. Now, of course, this is not yeah, we're not asking analysts what do you think the S&P 500's growth rate is going to be, because if we ask them that, they'd probably say something like 10 to 12, including dividend, I suppose, or say without dividends, the earnings growth will be sorry, the earnings growth would be something like high single digits or low double digits. But we're asking them, what do you think your company will do? And when you aggregate it all together, you get these kind of numbers, which we all know are nonsensical. You can't have earnings growing 21.9% for the S&P 500 when nominal GDP maybe is growing 5 to 6, 7%. I mean, the profit margin would have to go off the charts. In a competitive marketplace, margin shouldn't be able to do that. But then again, it is the roaring 2020s, and we do have technologies that are increasing productivity. Just to put this into some more perspective, 'cause I think it's interesting, is that you know, just thinking about irrational exuberance, is it just the PE concept? Can it also be an E concept? And the answer is yeah, it could also be an E concept. There could be some hype here in earnings. As you can see, the S&P 500 LTEG, long-term earnings growth, is up to 21.9. We had been somewhat higher in the pandemic, but that was kind of a messy situation with a lot of aberrations going on. So what we really want to do is compare it to back here, and so we're the highest we've been on record, with the exception of the messy situation in the pandemic. Back here, long-term earnings growth, the analysts got more and more optimistic, and then they realized they were wrong, and that all kind of the air came out. And leading back then was again information technology. That actually got to 28%, but this time around we're at 34%. So they're you know, I think that's where the risks lie. But I'd rather have a market going up on FEMO, forward earnings momentum, than on FOMO, which would be just kind of PE. On a PE basis, this is interesting, is the PE of the forward PE of the S&P is 21.1, while the forward PE of the S&P 500 Information Technology is 24.4. So there was some divergence here, obviously, but now they're closer, and that's because the forward PE of technology came down to a large extent because the E went up a lot. Quite a divergence from this bubble when the tech PE was got up to 55, and then it took a dive. Then because of the nature of E going down, it went up one more time. But the basic trend, once it peaked back here, it took a dive, and then it converged with the S&P 500, stayed real tight, and then it was right around here that you started to see tech outperform. Now this is 2022 is when we had Chat GPT, so we had that divergence. But again, it's not really FOMO. I mean, we could argue that the PE of the S&P is too high at 21.1. It should be 15. But I think this is reflecting sort of the credibility of our view, or the widespread acceptance of our view, that the economy is more resilient than people thought. It's not going to have a recession anytime soon. And if that's the case, it makes sense that the PE would be higher. Let me have a swig here. Okay, so kind of a case study within information technology, since semiconductors has become such a huge part of the technology sector. You can see that the forward earnings share of semiconductors in the technology sector is now 46.9%, and the market cap share is 45.1%. So the market cap share, the price, the relative importance of semiconductors has increased rather dramatically here, along with the earnings share. Let's just do one more shot here. This is we did the kind of updated our thoughts on the global market call. I don't know, we're doing more and more, and that's partly because we brought in a couple of smart young fellows. One is Toby Hurst, helping me out on the strategy side, and the other one is Elias Grippentrog. Toby is in Melbourne, Australia, and Elias is in Amsterdam, and of course we still have William stationed in Japan. So I like to think that we're a global firm now, that we have these offices, bureaus overseas. But anyways, we're working 24 by 7, and so we decided to try to on a regular basis give you more of a give you a quick take on the an update over the weekend once we have all the data for the week. So this is the S&P 500. We're doing MSCI now, U.S. MSCI compared to the all-country world ex-U.S. We had been recommending stay home all this time. We stayed too long here, back here, 2025. Go global, outperform, stay home. Now there's some kind of question mark of, well, now what? And I think the war clearly brought money back to the U.S. relative to the rest of the world. Um, an end of the war, which isn't clear yet, would probably benefit go global on a relative basis. This just shows that back here in late last year, we looked at this chart and said, well, the United States is already like almost somewhere around 63% of the market cap of the global MSCI. To recommend overweighting something that's already got this kind of weight is not kind of consistent with some thought of diversification and kind of reality. Does it make sense that the U.S. is kind of going to global up, a gobble up global, global up? Okay, gobble up global. Repeat that 10 times. Interesting, the emerging markets share of market cap is starting to show some signs of life. It's done that before and then kind of fizzled away. And of course, a good part of that is South Korea and Taiwan, which are basically AI plays. Um, this is the earnings share, and the earnings share of the U.S. is gigantic at over 50%. And again, you're seeing some pickup here in the earnings share of emerging markets. It's not all just South Korea and Taiwan, but a good part of it is. Meanwhile, when we look at forward earnings, we looked at it, the MSCI forward earnings for the U.S. That's the blue line. Same thing we looked at before, except that was the S&P 500. So they obviously it's going to be pretty close to the MSCI. MSCI is large caps and mid caps. For the rest of the world, things were looking pretty sleepy here for a while, and now looks like that's picking up. So the forward earnings story is looking better for the rest of the world. The forward PE is still a lot higher in the U.S., so the foreign markets are cheaper. They used to be pretty much the same PE, but since we got out of the great financial crisis, the U.S. has had a higher PE, and some of that is the overweight situation in technology. This is a handy dandy chart we'll show weekly, kind of looking at ETFs in dollars for the various countries. South Korea, Taiwan outperformers year to date. We had been, when we went to looking for opportunities overseas, we did recommend looking at emerging markets ex-China, and that's certainly been a home run compared to China. China's actually down. And the Chinese government's doing it again. They're intervening in the marketplaces. They're looking at some finagling going on in the AI space in the stock market. They're trying to clamp down on global flows, and that's weighing on the Chinese market. So meanwhile, the forward earnings, emerging markets, up and away. Again, South Korea, Taiwan, a big part of that. Stock market, the MSCI, all country world X, up and away, new record high. Developed countries, again, we're starting, excluding the U.S., we're starting to see that after sort of being in a flat line, things are improving on the earnings front. Um, and on a relative basis, the rest of the world is probably being hit harder by the war in Iran, the higher oil prices. And we see that in the Citigroup Economic Surprise Index, down sharply in Eurozone, actually going up in the U.S. That correlates real well with the bond yield. The bond yield has gone up. People are freaking out about it. We're not. We're sort of we've got a close relationship with the bond vigilantes. We're not bond vigilantes, but we We communicate with them subliminally, and we don't think that bonds have gotten out of hand. I think Bailey's walking around here somewhere. Europe again, the Eurozone PMIs, the services is down a lot. Manufacturing is down some. Maybe they're producing more defense in Europe. Germans, Eurozone consumer confidence down sharply. That got hit. So is ours. But our economy seems to be handling things better. Here's German industrial production just continuing to slide. So that's it. Let's see what we got here on the Q&A. From Matt, Dr. Ed, while the FEMO framework acknowledges private hyperscaler Anthropic valuations lifts S&P 500 earnings, what are your thoughts on earnings from companies that implement AI compared to those that sell it? And are the private company valuations feeding into 27 estimates? Um, it's a lot of questions and deserves a good answer. So, as you know, we do work on earnings, and we have been on top of the mark to market for some of the hyperscalers. But all in all, we will take a closer look at the 493. As I said, they look pretty good. The problem is the 493 includes some semiconductor companies like Micron that aren't in the Magnificent Seven. So that's the wonderful thing about our business. There's always something different and new. Denise, hi, Dr. Ed. Eric Wallerstein posted a chart indicating three companies are responsible for EM strength. Taiwan Semi, Samsung, and SK Hynix. Does your research agree with this? Yeah, absolutely. I mean, it's factual. It's just absolutely factual. But then again, let's see if I can quickly go back to sharing the screen. Share, and we're looking at this one. And then let's go back to this chart here. So, yeah, South Korea, Taiwan. I mean, this obviously is the same data that Eric's looking at, and this is the EM ex China. But anyway, Thailand did well, Israel, emerging market index, including China, EM Asia. Brazil is up there with a double-digit gain. This is year to date. Turkey, Poland has been a hot story. And then the soonest you get to developed countries is Japan, and then we got Mexico double-digit gains. So there have been emerging markets that have done quite well, outperformed the U.S. This is the U.S. at 9.3. Mexico's been higher than that. So yeah, Denise, as I said, there's a lot going on here, and you really have to get into the weeds sometimes, and we are, and we will continue to do so. To your point about EM, this is from JR. It would be interesting if there's a way to present EM, same question, EMX, Samsung, Hynix, and TSM. My hunch is that it would appear dramatically different. It would indeed. I've seen a chart like that, and we'll work on putting something together. I'll mention it to David and Joe. It goes down, but a big part of that is China. And we have not been recommending China. We've been particularly opposed to investing in that country. Again, a lot of nuances once you get into the weeds. I got a question from David. AI research from ProCap Insight says midterm years are historically bad for stocks, and that the trade is already forming across 9 midterm cycles since 1990. The S&P 500 has averaged a maximum drawdown of minus 17.5%. The max drawdown so far is only 9.1%, roughly half of the midterm average. That suggests that the real drawdown is still ahead, not behind. Any thoughts? Yeah, I look, we don't really play those kind of, I don't want to call them, I don't want to belittle them, but we don't play those kind of games. We don't do that kind of analysis, is a kind of a fairer way to say it. Um, kind of saying, well, this has happened 9 out of 10 times. So the odds are that it'll happen again are really high. We also don't do what I call technical analysis of fundamental data. As some people say, well, the leading indicator's always done this, therefore it must imply the same thing again. We tend to be, well, can I say more thoughtful? We kind of try to be more fundamental about these things than just say 9 out of 10 times it's happened, and it's going to happen again. And you're asking a very biased person this question, David, because we're in the roaring 2020s camp. So obviously, we're going to get very excited about anything that looks like roaring 2020s, and the earnings certainly look that way. And so, if the earnings don't somehow turn out to be bogus, if we don't have a recession, which brings earnings down, and the PE is reasonable at 21 in a world where recession looks, the U.S. economy has been stress tested. How many times has it been stress tested and it's still growing? So in that kind of situation, we're going to stick with our view that well, we could have a double-digit growth this year, which will be the fourth year in a row of double-digit growth. And then I guess we go and look at how many times has that happened and what happens next. Well, we are talking about the roaring 2030s. Uh, I'll take uh, I take two last questions here that I have from Lee. As AI provides tremendous benefits for productivity, perhaps no other similar tech has resulted in so much animosity. Even religious leaders hate it. Yeah, the Pope doesn't like it. As states, municipalities, and other restrict data center construction, will this impact the proliferation of AI and its applications? Moreover, if money can't be spent in building new centers, will the existing one be worth even more? That's a good point. And I just noticed an article somewhere, maybe it was on LinkedIn, saying that the value of old chips, of old GPUs has actually gone up because the new ones, I guess, are so expensive and the old ones are still serviceable and can still be used for some sorts of AI. Um, and then, of course, the hyperscalers are already thinking uh, outside the box of putting these things in outer space, putting them in the oceans. The oceans makes more sense to me than outer space. At least you can get somebody to take a swim and have a look at it if it needs some repairs. Lastly, do you see China turning around anytime soon? Not the consumer. It's all been kind of export led. Looks like they're mucking around with the business by uh, the government meddling in businesses' affairs. So no, I don't see them turning around. But I mean, they still got lots of let's not get too negative on China in terms of what they are capable of accomplishing. I just don't really want to invest there. Well, thanks very much for tuning in on Tuesday. Hope you had a relaxing weekend, and hope we can relax with the market going higher. But it's not going to be that easy. It's never that easy. There's always something. So we'll keep you apprised of our thinking. And again, thanks. We'll see you next week. Bye bye.